Welcome everybody to the first ever episode where I go over your investing questions and also questions on taxes related to investing. I'm really excited to do this. I've never done anything like this before on the channel, so I hope you guys get a lot out of it. I went through as many questions as I possibly could. If I don't address your question in this video, I apologize. I got so many responses, so many questions that I could only address a few of them. I tried to pick out some of the most common ones, and so those are the ones I'll be covering. However, if you guys like this video, just let me know by crushing that like button, leave a comment below, especially if you want to see more videos like this. And if I don't, like I said, if I didn't answer your question, feel free to drop it again in the comment section below, and I will do my best to get back to you. I do try to respond to as many people as possible. All right, guys, well, let's get into this. Just one quick announcement before we get started is that so I won't be able to post a new video on the channel until Sunday, June 2nd, so look for that. But I think you guys are gonna like what I have. I'm gonna be doing the second part of the Tax Diet series of how to minimize your taxes on investing. When you're investing, how do you minimize your taxes? That's what we'll be covering on June the 2nd, so mark your calendar. Without further ado, let's get started. So the first question we really have is from Olivia, and Olivia is brand new to investing, and thank you for your question, Olivia. And basically what she's saying is she says, Mike, I'm seriously afraid of investing into the market because of 2007, the crash, and watching my dad lose slightly more than half of his retirement, and just afraid of investing in general 12 years ago. And if you continue to read her comment down the line, down in the bottom part on the second half of her comment, she asked, do you get appreciation in stocks themselves besides dividend yield? So thank you for your question, Olivia. So a couple things here. I think many people are very afraid of investing after seeing what happened in 2007. So just a couple quick things on that. So before I ever started investing, I of course was afraid because I saw 2007, 2008 happen, and it's very hard to put your foot in the water after watching something like that and hearing about so many people losing money. Unfortunately, what has now happened is many people, when I mean many, I mean millions of people never got back into the market, or they sold at the wrong time. So not only did they actually lose real money, is they missed out on the huge upside that occurred after 2008. From 2008 until now, we've had a person could have doubled, tripled, or even quadrupled their money. So it's very hard when you encounter something like that. Couple quick things to help you alleviate some of that fear. One, I think having your debts paid off, or most of your debts paid off before you start investing, can be helpful. So like your credit cards, car loans, and I'm not talking about paying off your mortgage, but I'm talking about just your normal personal debts, even student loans. Before you go gung-ho on investing, have that squared away first. That's what my wife and I did so that we could invest without the fear of needing that money to pay debts. The second thing we did is we built up an emergency fund. So we have a 6 months of an emergency fund in place. So that basically we're building a foundation, a secure foundation before we ever start investing. So that when the market does its ups and downs, which it's totally gonna do, and it's probably gonna crash again. I don't know when. People have been talking about it for years now of when the next crash is coming. But, if you have your ducks in a row, if you have the other areas of your life squared away, like your debts and your finances, then even you're gonna feel more secure when you're risking that money in the market, and you can learn to invest over time and do it safely and securely. Well, you're not investing all of your money up front all at once. So you can take it slowly. Just take it one investment at a time, invest a little bit at a time. And for example, as I told you guys in the last video, I invest anywhere from $500 to $2,000 every time I place an investment transaction. And that's it. I have more money than that to invest at the moment, but I only invest that much per transaction because that's gonna help limit my risk. Because I'm under the assumption that I could be wrong. When I'm buying an investment, whether it's a stock or an ETF, I'm always under the assumption that, Mike, you might be wrong about this, or your timing might be wrong. Maybe it's gonna go down a little bit right after I buy it. So doing things slowly and strategically are gonna help you minimize any potential losses you have. And with dividend investing, what's nice is whether the stock's doing this or doing this, you're still gonna have some sort of dividend income coming in, more likely than not. And to address your second question, Olivia, yes, you will get underlying appreciation on the stocks you're invested in if they're doing well. So like, for example, I own American Water Works. That's a water utility company. It pays only like a 2 to 3% dividend yield, which I get that yield every year, but it's also has given me great appreciation over the years. I think in one of my accounts where I own it, I'm up 70% on that particular investment. So you're getting the dividend yield plus the stock appreciation if you're invested in good, solid companies. The next question we have is from Faraz. I hope I'm saying that right, Faraz. He says, do you watch PPCIan? So absolutely, I love PPCIan. So PPCIan, guys, is an incredible investor and YouTuber who I love watching. He's one of the people I can really learn from. There's a lot of people who claim to be teachers on YouTube, but they're really just entertainers and not teachers. But PPCIan, if you want to learn dividend investing, that's what this guy's channel is all about. He lives in San Francisco or around that area, and he's been doing dividend investing, I think, for over 20 years. He is somebody you can glean a lot of information from, so make sure you go check out his channel. Lots and lots to learn from him. Next question is from Tyler. The hardest part for me is just getting started. Paralysis by analysis is real. Tyler, I totally know where you're coming from because I was there. I've been in that position many times. But you have to remember that investing is not just a one-time thing. It's not even a two-time thing. It's something that you can do over your lifetime. When you start off, you're gonna be trying to figure out what investment do you invest in first. And so somebody had given me an example of, do I invest in Clorox or do I invest in Coke? And the answer is, it's easy to get all wrapped up in that one particular investment. But what you gotta realize is that you're gonna be investing more and more money into your account and then picking different investments over time. So don't get hung up on that. So if you look at investments, let's say you look at like 20 different investments and you narrow it down to the top 3 you're most interested in. Let's say it's McDonald's, Clorox, and Coke as an example. Well, of those 3 investments, McDonald's, Clorox, and Coke, determine which one, based on your research, based on your understanding of the company, the economy as a whole, which one do you think is best, and start there. So maybe you have $1,000 or $2,000 to invest up front. So let's say start off with buying $1,000 in Coke, for example, if that's what you feel for yourself based on your own research is the best example. Remember, it's next month you can invest in Clorox, and the following month you can invest in McDonald's. So it's really easy to get hung up and not invest in anything. But just remember, you're gonna be continually adding money to your account over your lifetime, guys, and you can continually pick new investments or add to the current positions you hold. I guess my message for you, Tyler, is don't be afraid to fail because failing is actually gonna help you learn. The other thing I would mention for you, Tyler, is that just remember that as long as you're not risking too much capital all at once, you're gonna be okay. So if you start off with $1,000 investment in Coke, you're gonna learn whether or not your analysis was correct. And the market's gonna do its thing. It's gonna do its ups and downs. And by doing it slowly, investing in Coke slowly over time, so maybe you don't buy Coke again for 6 more months or 3 more months, you're gonna figure out where the trend of that investment is going over that time span because you're investing in it slowly over time versus investing 10 grand all at once and freaking out if Coke goes down by 5%. Just remember when you're doing investing, it's not a one-time thing, it's not a 5-time thing, it's a lifetime thing, and that there's plenty of room over the course of your lifetime to change your course and to select different investments. Next question is from Nicholas. If one had a Roth IRA, would the dividend payouts you receive be taxable if you took them as cash instead of reinvesting them? I've gotten this question I think 10 times in the last month on dividend. When dividends go into a Roth IRA, are they taxable? The answer is no. So for example, let's say this is your investment account. And let's say this is the money you've put in, and then with this money, you've purchased stocks or ETFs. Now those ETFs, they are now paying dividends, right? So let's say at the end of the quarter, let's say it's March 31st or whatever, you get a cash dividend, okay? So you have cash going into your Roth IRA, right? That's your dividend payout right there. As long as that cash stays in your Roth IRA, it's not taxable. So all those dividends you're making in your Roth IRA all of that money is growing your cash balance in your account, it's not taxable at all, as long as you're following the rules of the Roth IRA. Now, the same is true if the money is being reinvested using like a dividend reinvestment program like a DRIP. Same thing. As long as that money stays in your Roth and you're not violating the rules of the Roth IRA, all those dividends are tax-free. And for this reason, I have other videos on my channel that talk about the power of investing in a Roth IRA over the course of your lifetime. Because when you're ready to retire, if you own income-producing assets within that Roth IRA, like REITs, dividend-paying stocks, whatever, that money, those dividends, you can take that money out tax-free and you can still maintain all of your investments in your account. You don't have to sell them off and you'll have an annual tax-free income. It's very powerful. So no, dividends that go into a Roth IRA are not taxable. Andrew, huge shout out to Andrew here. You guys, a lot of you talked about M1 Finance and how good of a platform it was. And so, Andrew, you pointed this out to me, so I really appreciate it. So you can do it. It sounds like if you read Andrew's post here, you can pause and read this, but you can do it with fractional. You can do fractional shares through M1 Finance, which is great. You can do rebalancing. He's really basically an advocate for M1 over Robinhood. So this is something, if you're looking for an investment platform, I totally recommend checking out M1 Finance. He taught me a lot here, and down here, he talks about you can do a Roth IRA as well within M1 Finance, and there's no fees. So you can take some time, you can pause the video to read what Andrew has to say. Andrew, huge shout out. Thank you so much for sharing this information. Now, honestly, guys, I learned a ton from you in this community. So always be checking the comments of the section of the channel and things like that, because you can glean a lot of great information and knowledge from other people. And somebody like Andrew obviously knows what he's talking about with M1. And, another person I wanted to give a shout out is to Dave R. He also leaves a lot of good posts and information. So thank you, Dave. I really appreciate everything you post on the channel and for sharing your knowledge. Now, Dave did ask a question, which I'll address here. Dave says, when I told my accountant that I have an IRA, which is tax-free, he said, no, not really. You still have to pay tax on gains at the end. Is he right? So Dave, I already responded to you, but it sounds like your accountant's very confused about investing in taxes. I'll be honest with you guys. Now, I've been doing work as a CPA for over 7 years now, and realistically, most accountants and CPAs, they're not investors. And so they're not usually the right people to ask about taxes when it comes to investments. And it should be the case, right? Because they're supposed to be experts on the subject. But many accountants do not understand investing whatsoever. And that is not an exaggeration. When you're investing in your Roth IRA, whether you're receiving dividends, which we just talked about, the dividend income going into your Roth IRA account, totally tax-free. The appreciation on your stocks or your ETFs within your Roth IRA, if you sell, let's say you own Coke, and you sell that stock within your Roth IRA and you have a $10,000 gain on Coke, it's completely tax-free because it's within your Roth IRA. And when you pull that money out as a distribution later on, it's still tax-free. So all the dividends and all the gains that you make or acquire within your Roth IRA are 100% tax-free as long as you do not violate the rules and conditions of your Roth IRA account. Next question comes from Scott. It says, I understand using dividend-paying stocks in a taxable account because if you get qualified dividends, you can have as low as 0 taxes. I don't follow putting dividend stocks in a Roth account brokerage because there is no tax benefit as there are always 0 in taxes and you can get higher yields even in S&P 500. All right, I think that's what you mean, Scott. All right, Scott. Well, if I understand your question correctly, so the reason one might consider putting dividend-paying stocks within a Roth IRA is because the dividends are tax-free. Now, in some circumstances, even with the money in a taxable brokerage account, once again, a taxable brokerage account, if your overall income is low enough, you could have 0 in taxes from dividends under the new capital gain rates rules, which I'll post on screen. So even in a taxable brokerage account, if your income is low enough and you're receiving dividends, it is true that you might be able to pay 0 in taxes on those dividends. Next question is from M&M's. I'm starting from $0 invested, but I'm sitting on $100,000 of free cash. I would love to get into the market but unsure of what's the best strategy. Wait for a large correction, recession, or cost average in 5,000 a month, something totally different. This is a question I get a lot. And so what I recommend to people before they ever start investing is to sit down and come up with some sort of strategy or some sort of plan before putting money into the market. To give you guys an example, like in my brokerage account and Roth IRA accounts, the focus is like 60 to 70% on income producing assets like REITs, dividend paying investments, and things, and maybe some bonds and things like that. The other 30% is in long-term growth assets like Amazon stock, Microsoft, Apple, companies like that. Because I'm not entirely 100% focused just on income. So I'm trying to balance it out between growth and income. But figuring out what you want to go for is important before you start investing, because once you know your strategy, that's going to help you determine what stocks to pick for your portfolio or what ETFs to pick. And in terms of timing the market, it's really hard. I mean, like I said, we very well could have a huge correction in the market very soon. I have no idea. People have been trying to guess it for the past 5 years, and every one of them has been wrong. They said the stock market was going to crash in 2018. Didn't happen. Kiyosaki in his book, The Prophecy, if you read that book, he claimed that in 2016 the market would crash. It didn't happen. So people have been trying to time the market for years, and most of them aren't good at it. And I'm one of them. I'm not good at timing the market. And so I think having cash on the side while simultaneously investing is a strategy that I've decided to partake in, because if I was just waiting for a recession, I would have missed out on all this upside. And I've been able to take advantage of the upside by dividing some of my money going into cash and some of my money going into investments. So I recommend doing a little bit of both, to be honest, because I don't know when this next recession is going to come. I think it's going to be hard. It's going to hit hard when it does come. But if you invest a fixed amount of money every month and you have your emergency fund in place, if you have your debts paid off, then I think you'll be fine. And if you're starting from $100,000, I would invest a few thousand per month, because if you're just starting investing, it takes time to learn how to manage a portfolio, how to analyze stocks, and all those things, which we're going to be discussing in future videos. So yeah, I would recommend M&M if you want to get involved in the market. Maybe invest a couple thousand per month and learn and be patient and learn from your mistakes and improving your skills by reading books and just watching the market and things like that, versus investing it all at once. This question is from Jorge. How's it going, brother? He says, I've put 18 grand for the past 3 years into my 401k account. Will it be the same thing if I do 13k in my 401k and 5k in a Roth IRA? Do you think I need to make changes? He says, I also tried day trading with okay results, but the stress was way too much. Jorge, thanks for your post. I think a lot of people have this question. So when it comes to investing, what's my preference? Would I go for a 401k first, or would I go for a Roth IRA first? So to the extent I get an employer match in my 401k, I would do the 401k first. But once I'm no longer getting a match or a benefit from investing in my 401k, then I'm going right to the Roth. I think the Roth IRA is more advantageous because you have more investment selections. The money comes out completely tax-free, and there's little to no fees. Whereas the 401k has very high fees. So as much as possible, if you were to say, Mike, if you had to choose between one or the other, well, I'd probably start with my Roth IRA first if I was not getting a match at all from my employer, and then go from there. And we also build the cash reserves on the side. So I'm doing all of those things, guys. So as you can see, I have multiple things going on here, but I wanted to share that with you so you have an idea of what we're doing. Jason asks, what is your strategy in adding to positions on stocks? Do you wait until the price goes down, or do you just add into every month regardless? Thanks. Jason, fantastic question. I know a lot of people have this question. So whenever I'm about to buy a stock or ETF, I always buy it on the day when the market's down, or when that particular investment's down. So let's say I want to add shares to Microsoft, for example. Well, when I see Microsoft is down 1 or 2%, that's when I'll buy it. I never buy when it's on an up day, because the market's constantly doing this. So always buy it when the stock's in the red for that day, or when the ETF's in the red for that day, because at least you're going to get some sort of discount when you're adding to that position. And I don't add into the position every month. I usually, each month, I'll look at what the market's doing, what the economy's doing, and I'll decide if I want to add to a current position or invest in an entirely new investment entirely based on what opportunities I'm observing in the market. So that's what I do. Adrian asks, so in this comment, Adrian's basically asking, Mike, do you have a video that shows all my investments? Thanks again. Hi, Adrian. A lot of people have asked this question. I currently do not, and there's a reason for that, is that on this channel, I hope you guys can see that I'm actually trying to teach you. I'm not trying just to entertain you. I'm not a very good entertainer to begin with. That would be Chipper, by the way. Chipper's the entertainer on this channel.
Damn, I'm good.
So there's some people, if I showed you my whole stock list, if I showed them my entire list of ETFs and stocks, they would try to copy everything I do. And I wouldn't want somebody to do that. One, because I've made, though that list of investments would have some mistakes in it. And I wouldn't invest in everything I did in the past. And so I want you to get to the point where you can exercise judgment, good judgment. And the way you're going to learn judgment and how to truly invest is for you to actually invest on a consistent basis, track your results, and through your different experiences, whether your investment choice was good, whether it was bad, you're going to learn judgment over time of how to become a better and better investor, how to become a better portfolio manager. But if I were to show you just my stocks, my investments, it might not be the best investments for you, because you're gonna be just copying me, and it might not fit your long-term goals. I know what my long-term goals are for my accounts, but you, as an investor, need to know what your long-term goals are for your accounts. And so that's why I'm not showing my full stock list. But if you watch my videos, I'll share many of the stocks I own. Like I don't mind doing that. Like I own Blackstone, Chevron, Microsoft, Procter & Gamble, Johnson & Johnson, real estate investment trust like Medical Properties Trust, which is I think MPW ticker symbol. I own I think it's EPR is a REIT I own. They own entertainment properties. I think another REIT I own is NHI, which is a healthcare REIT. There's different investments I own, but if I wouldn't do it exactly the same if I were to start over, because not all of them went well. And when I first started off, I didn't know how to manage a portfolio. Today, I know much better how to manage a portfolio and to minimize my risk of loss and increase my profits. All right, guys, we're on to the last question, then we're gonna wrap this up. So this particular viewer, if you read their comment, if you really read it, it's basically asking that, do I only invest in dividend paying stocks, or do I invest for growth as well? As I mentioned earlier in the video, I do invest for growth. And I think investing for growth as well can be a very important part of your long-term investing strategy. Because I don't want you guys to get so focused that you only invest for dividend income, because there's plenty of great ETFs, great investments that have grown substantially over the years that can really fuel the growth of your overall portfolio. And so I would hate to have you miss out on growth. Now for me, like I mentioned, if you look at my Roths, our 2 Roth IRAs and our taxable brokerage account, if you were to look at on a broad scale, the investment allocation is about 70% in income producing assets, 60 to 70% roughly, and the other 30 to 40% is in growth stocks. So by capturing growth, what I like about growth is it's gonna grow my account balance quicker if I've chosen the right investments, if I'm getting good appreciation. Then what can happen, or what I can plan to do later on, is once those companies reach a substantial amount, I could then, as I'm getting nearer to retirement, or feel like it's a good time to sell some of those shares, I can take that money, take those gains, and then reinvest them into dividend producing assets to help fuel my retirement income. Whereas if I were to try to do that all from dividend investing, it's gonna be a little slower. So that's why I like to have both dividend, like a dividend investing strategy, as well as growth, because that money I can use to fuel my account, or maybe I sell Amazon or Microsoft or whatever, and use that money to help me purchase a rental property in the future. All right, guys, I'm gonna wrap up the video here. Like I said earlier, if you liked the video, make sure you crush that like button. Let me know if you'd wanna see more videos like this. I got a lot of good investing and tax videos coming your way here in the near future. Remember, the next video I'm publishing on the channel is gonna be on June 2nd, and we're gonna talk about how to minimize your taxes in investing. Until then, make sure you subscribe to the channel so you do not miss any of our future uploads. Here on Money in Life TV, our focus and mission is to help you become fiscally fit as we teach finances, investing, taxes, and more on a regular basis. I love you all. Thank you so much for the support. Thank you for over 20,000 subscribers. You make this entirely worthwhile, and I just can't believe we're here, guys. It's so rewarding to do this, and not only to interact with you guys, but to know I'm helping people around the country and being able to learn from all of you as well in the process. It's fantastic. All right, I love you all. Live life on cage, guys. I'll see you in the next one. Peace.